Hey everyone, and welcome. So today we're going to dive into a really fascinating concept that traders use to spot clues hiding in plain sight. It's called market divergence, and it's all about what happens when a stock's price and its real underlying momentum, well, they start telling two completely different stories. So here's the big question, right? How on earth do you spot a trend's turning point before it actually happens? I mean, that's the ultimate challenge for any investor. It's about learning to look past the obvious price chart to see what's really bubbling up under the surface. It's about getting a little peek into the future. So here's our game plan for today. First, we'll talk about the challenge of predicting a reversal. Then, we'll get into what it means when price and momentum disagree. After that, we'll see how traders grade these signals, what tools they use, and finally, we'll wrap it all up with the big takeaway. All right, let's jump right in. Section 1, predicting a market reversal. This is the fundamental problem that Divergence is trying to help us solve. Okay, so think about it this way. A stock's price is kind of like the speedometer in your car. It tells you exactly how fast you're going right now. It's a fact. It's history. But momentum is more like the sound of the engine. Is it revving up, full of power, or is it starting to sputter and strain, even if your speed is still high? That sound, that hints at what's coming next. Okay, so that brings us to the really juicy part. Section 2, when price and momentum disagree. This is where we really start to learn the secret language of the market. And that disagreement, well, it has a name. It's called divergence. It's simply when the price of an asset is going one way, but the indicator that measures its momentum is going the complete opposite way. The speedometer says one thing, but the engine is telling a totally different story. Now, divergence comes in two main flavors. With a bullish divergence, you'll see the price hit a scary new low. But if you look at the momentum indicator, it's actually making a higher low. It's a clue that the sellers are getting exhausted. On the flip side, with a bearish divergence, the price is hitting a new peak, everything looks great, but the momentum is quietly making a lower high, suggesting the rally is running out of gas. See the disconnect? And this quote from Investopedia just nails the feeling behind a bearish divergence. It says, "Bulls are losing their grip on the market. Prices are rising only as a result of inertia, and the bears are ready to take control again." It's not just about numbers. It's a story of a power struggle happening right under our noses. But, and this is super important, not all of these disagreements are created equal. Some are just minor arguments, but others are signs of a massive shift coming. So let's move on to Section 3, grading the divergence signal. Traders actually have a grading system for this stuff. Class A, B, and C. As you can probably guess, Class A is the big one. That's your strongest, most reliable signal, the one that makes traders really sit up and pay attention. Class B is, well, it's medium, and Class C is the weakest, often just market noise. So what makes a Class A signal so special? Look at the table. It's when the disagreement is the most dramatic. For a bullish signal, the price is making a brand new low, but momentum is already climbing with a higher low. That huge contrast is what signals a powerful potential reversal. As you go down to B and C, the disagreement gets less intense, which is why the signals are considered weaker. Okay, we've been throwing this word momentum around a lot, but how do you actually measure it? Let's get into the tools of the trade in Section 4, measuring the market speed. Well, traders use these tools called oscillators. Two of the most popular are called momentum and rate of change, or ROC for short. They're basically just fancy calculators designed to do one simple thing: tell you if a trend is speeding up or slowing down by comparing today's price to a price from the past. And here's the easy way to tell them apart. The momentum indicator just uses simple subtraction. It asks, what's the absolute dollar change? Rate of change, on the other hand, uses division. It's asking, what's the percentage change? So it's just two different lenses to look at the same exact question. Is this thing gaining or losing steam? All right, time to put all the pieces together. Let's move to our final section. Section 5, the trader's takeaway. What does this all really mean? So let's boil this all down. The big idea is that divergences are like an early warning system. They show you when a trend's momentum is starting to fade. Remember the patterns? Bullish is price down, momentum up. Bearish is price up, momentum down. And if you're looking for the most powerful signs of a reversal, it's those Class A divergences that you really want to watch out for. And here's the bottom line. Divergence isn't some magic crystal ball that predicts the future with 100% accuracy. No way. What it is a powerful tool for understanding market psychology, that constant tug of war between buyers and sellers. And by spotting when momentum is fading, it helps traders manage their risk and just make smarter decisions. And that brings us right back to the beginning, doesn't it? The price on the chart shows you where the market has been. It's the past. But the momentum gives you hints about where it might be going. So the real question is, which story are you going to listen to?